welcome back, traders. This is another session with me, Vadim, and Rob, my personal mentor and best trader I've ever seen or met or had the privilege to work with. And we're going to continue our discussion on trading psychology, and technical aspects of trading. And it's been a couple of weeks. We had two Periscope sessions, though. So I suggest you watch those on Rob's YouTube channel or his Facebook channel, and also follow Rob on Periscope. You should be able to find a link in the description of this video. But let's welcome Rob back to the interview series. Hi, Rob.
Hey, Vadim. Thanks for having me today.
Let's jump right into it. Let's start by talking about something we touched upon this morning. And that is, well, how should I say it? Trading rooms, mentors, review websites.
Oh, right. You had sent a link over to me this morning for tradingschools.org. And that website is run by Emmett Moore. And he's on a mission to kind of uncover misrepresentation that's maybe going on in the industry. There's a lot of smoke and mirrors out there for people learning and wanting to become traders. And a lot of the resources out there can lead you down a tough path. Part of the problem with this industry is, as we know, a really large percentage of traders ultimately fail. And so that leads a lot of guys who otherwise would have just gone their way to say, well, wait a minute, I lost money as a trader, but I could take all this stuff that I came up with and all this money that I spent, and I could potentially market it and recoup some of the money back, or, this kind of thing.
Mm-hmm.
And so Emmett started a site there, tradingschools.org, for kind of uncovering or helping traders to know what's going on there. Now, Emmett had reached out to me, and he had also reached out to Robin's trading company about our performance and whatnot. And he wanted to review our site, but because I don't make claims about performance that you're going to get, see, it's actually my belief that, and this is a problem, say, we trade in crude oil, for example. Let's say, and I might have said this in one of the prior interviews, so I'll just give it a Reader's Digest version. If I'm running a trading room and I go long, and then I tell 200 guys in the room who are all trading 2, 3, 4 lots or whatever to go long, the market's going to move in my direction. And so on the orders that I've created by saying to go long, and I can scalp out of that, and that of course would be extremely unethical to do something like that, but this kind of thing goes on. And so anyways, originally he wanted to review our site, and I gave him the information that he needed to do that, but the problem is to really review what it is that we're doing in our trading room is a in-depth experience. For example, Traders World Magazine has been reviewing our site and is even writing a book on it that will be coming out soon, if I'm not mistaken. Mm-hmm. And he's been in there every day for 3 months. Mm. He's been in there every day for 3 months. He's interviewed traders that have been in the room and who've worked with us and this sort of thing. But that's the kind of commitment it would take to do a real true review of what it is that we do in the room. But part of what we've talked about in prior meetings, what the room is really about is helping you to become independent. And so though the trades are on the screen and we talk about the trades that are there and everything else, what we don't do is make a recommendation for 200 guys to all fire a 4 lot in crude oil, because if we did that, you'd have a problem. We find that actually everybody can get filled on a trade if they're all doing it at their own individual time, because the order book's kind of filling in as it goes.
Mm-hmm.
But to just fire, hundreds and hundreds of lots, unless it was the ES,
Mm-hmm.
you know. And so, anyways, he's on a passionate mission to kind of help traders to not go down the wrong path, and I think he's doing a good job over there. And if they review something and the trading room doesn't agree with it, they have they can get with him and correct it. He'll do corrected reviews if he feels that he's been misleading in some way. But anyways, he's on a mission over there to kind of help out with that. But it's an interesting thing that's going on there. Yeah.
Mm-hmm. Now, speaking of a book, last interview you mentioned that you're contemplating writing a book of your own.
Yes. I've written out chapters for what I would do as a trading book. I'm not making a commitment to get this done yet, but I've got 100, and it might ultimately end up being done in several books. But I just did a brainstorm session and came up with over, I think, 108 different chapter headings. Now, if I just sat down and started writing that, because trading is really my life, and just started letting that roll off my tongue, that book would write itself. But I haven't found the time. Anybody who's been following what we do and knows a little bit about me, I won't approach that project until I'm absolutely sure that my passion is there, because if the passion is there, then I can see the writing of it through to completion. And so I won't start the book unless I know I'm going to finish it all in one session. And so I wrote, like when I wrote the manual for our indicators, this is about 350-page manual, and I wrote that. It took about 5 weeks. Right? Yeah. But that's never been released as public information. Except for in the oil trading room itself, many of those concepts within that book, if you will, are revealed on a daily basis, and then some. And so, but there's just so many topics that can be covered. Trading can cover a lot of territory and different ways that you can approach it. And so it's a vast topic and area of interest. So yeah, at some point I will get that done.
So is that manual available to the members currently?
That originally, the way I started creating indicators for trading, I had a broker reach out to me, and he said, "Hey, Rob, my customers, they all lose money." He might not have said all, but can you write some indicators and some things that can help my customers? That's how it started. I didn't really intend to, because I'm a trader, and then you start becoming a lot of things. You start becoming a software developer, you start becoming a customer service representative, you start becoming a lot of things that are well beyond just being a trader.
Marketing.
Marketing, and things related to personal development. Now, actually, for me, that aspect of it has been the most rewarding part, is helping traders to develop, not just as traders, but as people who are self-empowered. And so, but that old that original material, that was the original package that that was released for trading, and by and large, I have not changed any of those. There have been a couple of new tools that came along the way, but by and large, those original tools I never changed from those, and so the concepts and everything that are in there. But that manual itself is now delivered either through the Smart Patterns trading system, if you get the Smart Patterns trading system, or it's delivered also through the oil trading room.
Mm-hmm.
Those concepts are openly kind of explored on an ongoing basis in the oil trading room on a day-to-day basis. So,
Mm-hmm.
and so that's the way that gets delivered nowadays.
Mm-hmm. Let's shift gears and talk about. I don't think we've talked about this topic yet. Um, for say seasoned traders, where they let's say they've been trading for a while and they've accumulated all kinds of experiences in volatile markets, for example, and the idea of you know fear, um, like fear-based trading or non-trading, where kind of paralyzes you.
This issue, and I don't think we've discussed this so far, this is a huge issue. This is the single most common issue that I see with guys is um, is having fear come into their trading, and it's actually absolutely disabling.
Mm-hmm.
And this is why, like a few minutes ago, or in any of these prior interviews, where we really get into with these things is about personal development.
Mm-hmm.
Because if fear is a major part of your life, if you are being triggered into a state of fear, you're really that's a really tough thing to deal with, and it can be a tough thing to overcome. And so I see this over and over and over again. The traders, by the time they get to me, they've already blown out a couple of accounts. Now you've got to kind of take that for what it is, because if you haven't learned how to lose, you probably won't. I don't know anybody who's ever come to trading who didn't lose first. You got
Mm-hmm.
to lose first, and then you go, wait a minute, I need to get my act together, you know.
Mm-hmm.
And then with the appropriate effort and resources, you can do that. I've had medical doctors with extensive training come to me and say trading is the most humbling endeavor I've ever undertaken.
Mm-hmm.
And um, and so uh, this is entirely true, because it puts back in your face just exactly what you are. And so by the time you've blown out your first account, at one level you're ready to move forward and propel yourself forward as a trader. But then what happens is the trader actually becomes paralyzed and unable to do a couple of different things. One, unable to pull the trigger and take the trade.
Mm-hmm.
They'll literally freeze and they can't do it.
Mm-hmm.
And the next one is they'll be able to get themselves into the trade, but they go into such a panic attack, kind of a state of fight or flight response, and I think we've talked about that in prior interviews. It's literally like you're being attacked. That's what your body perception is,
Mm-hmm.
that you're being attacked. Now, um, the prime directive of your unconscious mind is to protect the body.
Mm-hmm.
And so when you go into fight or flight response, you're basically like an antelope being chased by a lion.
Mm-hmm.
And you're not exactly rational when you're in that state.
Mm-hmm.
And so all you're trying to do is whatever it takes to get back to homeostasis. to get back to balance. Now, humans are different than the antelope that's being chased by the lion. The antelope knows the game, okay? There's a lion, he's at the edge of the, of the savannah or whatever, and the lion's like doing this hunching down thing, and the antelope, they kind of see him, they're gregarious animals, they're all there together, and the lion's kind of analyzing and trying to figure out which one of them's the weakest, because lions might be a little lazy, and so he picked up, that's the weak one right there. That's the one I'm going to go after, and then the game is on, right? Now the antelope knows what the game is, and the lion knows what the game is, and so the antelope, they're fast, and they're also good at making evasive maneuvers and everything else. The interesting thing with the antelope is they'll do the chase, they'll run the lion down until the lion gives up, and then they just within a matter of minutes go back to grazing, like nothing happened.
Yeah.
It's like nothing happened. Human? No, because a human has the capacity for operating on reality symbolically. And so it doesn't matter to this thing right here if it's real or perceived or a dream. The neural pathways for experience and a dream, it's the same neural pathways. It's not like you've got neural pathways for things that are out there and you've got neural pathways for things that are in here or in here, whatever. It's the same circuitry. There's no differentiation between internal and external experience. And so what the human does is they perceive the actual entering of the trade as a lion chasing them. If you'll allow me to metaphorically describe that experience. And so either they freeze up and they can't click the button, which means you miss out. And then you literally sit there and watch the market run away from you, which is a very difficult place to be mentally, because you've put all these resources and everything towards this goal, and then you can't do it when you get to that instant in time, that present moment experience in time where you need to do that, and it runs away from you, and then you run into self-condemnation and feeling bad about yourself because you can't operate. And the second one is that you can actually enter the trade, but then you go into such a panic attack because of the symbolic reality that you're holding out, that you're under duress, you're in a panic, and they won't be able to hold the trade out to completion. So this is the second sin, if you will, and it's probably a worse one than not pulling the trigger in the first place, because at least if you didn't pull the trigger in the first place, I'm going to take this to one more level. But if you didn't pull the trigger in the first place, at least you're not in. It's not like you're under, you're feeling as though you're in. You're still under panic, but you didn't get in the trade. You missed it out. Now you're under self-condemnation, internal voices, you're an idiot, and all this kind of stuff. And the second one enters the trade, and then they can't let it develop, so they get out of the trade and it runs away. The problem is with that guy is because he's running by fear, he's operating through fear, he will almost invariably find the worst places to enter the market. You find the worst places to enter the market. And so, like, if I'm reviewing a chart, if I tell them, okay, make up a chart, I've actually had several traders in the last couple of days do this, which is I'm really glad about, because I try to get guys to do it. There's 3 phases to this kind of development. We'll talk about that in a second too. But so the guy marks a chart and sends it in. Okay, I can see that I should trade here and I should trade here. But what I notice on the chart is that the trader is waiting for the market to have already moved a lot before he's going to get in. And so then it's more like he's operating on a fear of missing out, that, rather than getting in early in the move. You want to get in early in a move. And the thing is, as a trader, very often you're going to be making that decision out of a confusion state. The market is just kind of like chopping around, and then it starts to break out. And so the decision point that is really the sweet spot of where you know you got to go, that becomes a skill that you develop over time. Now, how do you develop a skill like that? Well, there's 3 stages to developing a skill like that. The first is identifying what on your charts is actually a trading opportunity. That'd be phase 1. That you can look at a chart and you can go, oh, it's like I'm looking at this chart right here. Oh, it's a double top right there. Trend is down, A, B, C, D, E, F, G, H. The market comes up, tags into this area again, double tops. I'm not going to go look at the details of this, and this is the sell right in here. Okay. So the trader can recognize that that's opportunity looking at them right there. For example, all right, that's phase 1. Now, phase 2, then what you really want to do is you want to be able to mark that on your chart. So you could go back over historical charts and mark that on your chart. Phase 2 is to be able to mark it on the chart and understand the larger context that you're operating in. Like, what is the appropriate range between this period of the day and this period of the day? It's the last period of the day, K period, we call it. So I'm just saying, what is the normal range between H and K? And where am I in it? And so then you're marking the charts historically with some understanding of the context that you're in. So that's stage 2. Stage 3 that makes a master trader is being able to do that on a live chart and actually anticipate what's happening. So you're literally sitting there saying, this market's trying to go down. And then you're also saying, well, and I expect this much range, and I know that statistically makes sense. And then third, there's a setup, and I know within that structure of that setup that my risk is this doesn't sell. And so then you've got one more question to ask, and that is the risk worth the potential reward? So all those things funnel down to having a present moment experience on your trading chart. Now, if you're using some kind of automated trading, you can bypass that. But then there are pitfalls of automated trading systems that can get you into a lot of, it's a whole other story. But what I'm describing to you here is trading on a chart as big capital A, capital S, present moment experience. And so that can be a very enlightening endeavor. Actually, trading on at any level can be a very enlightening endeavor because you still have to pull the trigger. You still got to be able to manage the trade through to completion. If you think about it, if you're trading with an entry, a stop, and a target, without any regard to anything else, each one of those is 1/3 of the component, right? 1/3, 1/3, 1/3. So I could enter the trade on the first third and get stopped out. I could enter the trade and it could go towards my target but never make there and come back and get stopped out. Or I could enter the trade and it goes to my target without ever hitting the stop. If you just structurally look at the math of that, it's about 66% against. Just kind of just throwing it out there as a general idea, right? And so you got to be, you have to have things lined up in your favor. And so no wonder traders are so fearful, because the way they're playing the game, it's 66% against, which
Mhm.
means you got about 1/3 in your favor. Well, that's not good. You can't operate there.
Mhm.
I've found over the years of doing this that traders need to have a high win percentage in general to be able to stay in the game.
Mhm.
You can't give a guy a system with a 23% win and he'll just take the trades faithfully.
Mhm.
We'll be able to do it. But if you can get it up towards the 80 plus mark,
Mhm.
they'll be able to do it. And particularly if you get statistics and things like that lined up with it. And so you got to be really, you got to line things up in your favor because the whole trading game is rigged to take you out. Now I think we've talked in prior interviews about the notion of a stop being risk. Because I'll get guys sending me the email. Oh, what size stops do you use? What's your risk? Meaning the same thing. But a stop isn't risk. A stop is only risk if it gets hit.
Mhm.
Because if you can simply get that stop to a place where it's protected and it's not likely to be hit, then the probabilities start shifting to 50%. And then all you got to do is add one more little tweak, and now you're into 60, 70, 80% in your favor.
Mhm.
It doesn't take much to shift that probability curve in your favor, particularly if you can get some level of management of your stop loss order such that it rarely gets hit. Yeah, and that's about trade placement and the way that you accomplish that back to the 3 stages thing um, is number one to be able to identify the positions, number two to understand it within the context, and then ultimately be able to see it and identify it in real time, and then one step further, uh, not only identifying it in real time but actually anticipating the occurrence.
Mhm.
And once you get there, you're a master, and it's just a matter of time. And I don't care what time frame you're trading on or anything else. You get these things lined up, uh, and you understand it. When I say understand, I mean you intuitively know where you are in the grand scheme of things, so you can carry things through to completion. Then you're well on your way to being a master trader. And this is the kind of thing that I try to teach, but it's really about personal development, because to be able to do all these things, it's kind of crazy because the market only goes up or down, or it slops around sideways and then goes up or down. You'd think it'd be simple,
Mhm.
but when you get down into the nitty gritty of it, it's a wonderfully challenging activity to engage in, and it puts you right in your face.
Mhm.
That's what I love about it. It puts you right in your face. We have met the enemy, and
Mhm.
we are it. you know, and so this is why um, I really push on the personal responsibility aspect of it, because if you blame uh, your your little failures on some external thing, then you literally give all your power away, and you make it impossible for you to grow and develop.
Mhm.
And so I work with guys a lot about taking the responsibility for it, and then boy, your learning just like accelerates, because you got to look in yourself and say, in the mirror, and you got to say, what is it that I'm doing? And then it just becomes simple problem solving and resolving that within yourself, and then you're on your way to becoming a great trader.
Mhm.
But it takes work because you're in the way. You know,
Mhm.
the the rest of it's like math and just process. You know, and so it's it's a very interesting thing. So that whole fear equation is overcome through the process of understanding. You know, what's the old saying? Fear is false evidence appearing as real.
Mhm.
Well, it's false. You're operating on what you're doing symbolically, and you don't understand the real problem that you're dealing with.
Mhm.
But then as you gain understanding of the problem that you're dealing with, suddenly you start gaining all kinds of freedom and self-empowerment.
Mm-hmm.
as long as you're taking full responsibility for the outcome that you're getting. And therein lies the secret of of really being a great trader. And it doesn't necessarily have to be some deep, profound thing. To me, it ends up kind of being that way, just the way I happen to be wired. But a lot of the best traders are just really simple people.
Mm-hmm.
But they get it. They get it. It's like they know what's at play, and so they take responsibility for the outcome they're getting, and they adjust their behavior to get what they want. You
Mm-hmm.
know.
Mm-hmm.
Yeah. So, anyways, great question about the fear. It's a huge issue. Huge issue.
So like successful institutions, they have the money managers, the analysts, and the traders, and they're all got their own jobs. So.
Yes, this becomes an issue too. Like for me, you know, I operate from home. I'm, keeping things pretty simple, and so I'm the research department and I'm the trading department.
Mm-hmm.
At a large firm, the analysts and the traders are kept separate.
Mm-hmm.
The analysts will give information to the traders because the problem this is another pitfall that you can get yourself into when you do research. Number one, when you do research, you have to absolutely positively understand that you have to engage in the trading in the same way that your research was done. And you can sometimes fool yourself that the research that you thought that you did wasn't what it actually was. And that comes with experience too. I'm saying, let's say you compute a statistic about a certain kind of structure that's setting up in the market or something like this, and you just misinterpret it a little bit. And then when you go to implement it in real time, you find that it doesn't work. But then you go back and you look at the stat and you're like, no, it works. It's like, well, oh my goodness, oh, I did that. I shifted the data or something like that. So you got to be careful about that. But you, when you do research and um, you know 47 different ways to slice and dice it,
Mm-hmm.
that knowledge can actually interfere with your that knowledge can actually interfere with your trading because you will be modulating in your mind all these different variations on the theme and everything else.
Mm-hmm.
So if you can keep separate it's actually a huge blessing to have your research, like, say somebody who's an oil trading room member and we're providing this research to the trader. Number one, we know how to do the research so that it's not a confound and you don't end up firing a trade into something that doesn't work because you misinterpreted your study. And number two, you don't know 47 ways to slice it and dice it like I do.
Mm-hmm.
And so I have to deal with that within myself every day. It's like, well, this is saying it's going up, but this is saying it's going down. But then on the other hand, this is, it's like you got four, like I said, 40, the Heinz 57 varieties going on inside your head.
Mm-hmm.
One thing that is nice though, because you want to be able to be playing those things out in your head at some level. You want to be able to look at the market because there's always going to be something against you. At the best time to trade, there's always going to be something stacking up against you there, and so you want to be able to understand it enough, these what's for and what's against, enough that you start saying, wait a minute, no, this thing's going to explode, and so I got to go with it right now. Yeah,
Mm-hmm.
and so but to know 20 years of research.
Mm-hmm.
It's like you can shout out, in there. And so um, that will, if you become a researcher, and see, for me, I'm like a pattern guy. I'm the pattern master. So, I'm always, I mean, if I'm driving down the road and a guy, stop at a stoplight, there's a license plate in front of me, and I'll start seeing patterns in the guy's license plate. I'll see patterns everywhere. What's that? A Nash, what was that movie with Russell Crowe where, John Nash, and he's solving all the codes for the government and everything, and then they find he's got this shed with all the numbers all over everything in it, and he thinks he's solving these codes, but he's actually living in some other reality that doesn't even exist. And actually, all the kinds of things that happen in that movie are like the kinds of things that we're talking about here.
Mm-hmm.
Holding out a symbolic reality that isn't really what reality is, but yet you manage to find a way to make it work at some level, but it's not really working in trading, but and it goes on and on. So that, what's the subject? Truth. Truth. So you find truth and you align with it, and then you get what you want. So it's cool. Yeah.
So when you're trading, say, out of fear or with fear, you do start to see trading or a trade as an event versus a process.
Yes. And trading is always a process, and it needs to be treated as such. Sometimes you get into a trade and you'll realize you made the wrong decision.
Mm-hmm.
It's like you be in the trade, and sometimes you get into the trade, and like suddenly all this stuff starts coming to you. It's like, oh my goodness, I never should have fired you.
Mm-hmm. As soon as you get in, you're like,
Yeah,
what did I
but
just
but
do?
see, that's a wonderful place to be from a development standpoint.
Mm-hmm. Mm-hmm.
You get in the trade, you realize it was wrong. You're not going to forget that.
Yeah, it just comes back to that planning your trades.
Yeah, exactly. And so it's actually a blessing.
Mm-hmm.
See, all this stuff's a blessing because you got this feedback mechanism that's helping you to be awesome.
Mm-hmm.
And so if you actually embrace that process,
Mm-hmm.
um, you get to be traveling towards awesome. And any man who knows he's traveling towards awesome is a complete man. And any man who knows that he's not is not a man.
Mm-hmm.
I mean, the gals too, of course, but I'm just saying,
Mm-hmm.
human,
Mm-hmm.
a human has to know that he's got a purpose,
Mm-hmm.
or to start making one up that might not have anything to do with reality. So either you're in truth or you're not. If you're not in truth, you give up your power. If you are in truth, you get your power. And then, but it's always in developing it, because what works out there is changing a little here and there. Yeah, that's the other beauty about trading. It's never quite exactly the same.
Mm-hmm.
Always a little different.
About post-trading day analysis.
Um, I strongly, and I already had kind of covered that. After hours, take that chart and go over every single thing that's set up.
Mm-hmm.
You go over every single thing that's set up until you know that you're not missing any of them. That's why I tell the traders that I train to send in the charts, because there's going to be stuff all over the chart that they didn't see.
Mm-hmm.
And so I always go over my charts at the end of the day. Now, I've been doing this a long time, so I'm pretty good at it. It doesn't really take me very long. But learning to identify what's happening on a chart is a skill set. It's like a language.
Mm-hmm.
I said this like a language, but it's totally like a language, and you can become fluent in that language. And when you can express yourself well, people respond to you. Well, when you can express yourself well and you understand the language of the market, then you can function within it with competency. But if you got a 600-word vocabulary, people are going to get tired of dealing with you. And,
Mm-hmm.
things aren't going to work out for the best for you all the time. So you try to get to a point where you can articulate within the language in a way that doesn't make you sound like you're some kind of a computer or something,
Mm-hmm.
and you're just doing it in a fluent, natural way. Just like we're having a conversation right now. Just kind of like it's like it's just kind of flowing off the tongue, and you're not trying to turn it into something that's not. So.
So do you sometimes still miss, your setups during the day?
Yeah, it doesn't happen a real lot. I usually know this whole thing, this three stages thing that I said earlier. Um, being able to identify a basic trade setup within a given known workable structure, right?
Mm-hmm.
Number two, being able to identify it as it's happening, being able to actually anticipate it in the
Mm-hmm.
third phase, where you're actually saying, this is probably what's unfolding here. If the market does this, thus, and so, I'm going to hop on right there, and it's 10 minutes later that it does it.
Uh-huh. Right.
Now, that gives you a lot of patience.
Mm-hmm.
That
Mm-hmm.
gives you a lot of patience because you're going, oh, I see what it's doing. It's trapping.
Right. You're not
It's
reacting anymore.
Yeah, you're not reacting. The market's trapping right here.
Mm-hmm.
So that's what markets like to do. They trap. I
Mm-hmm.
mean, not that the market is like a personality, but it's this constant game of alternation, getting people on the wrong side.
So for market to move, um, most people need to be kind of in a negative.
Yeah, well,
Or
okay. Let's talk about that for a minute because I don't know if we've ever talked about that on how do markets work? Okay, markets, number one, why does a market go down? To find buyers.
mm-hmm.
Why does the market go up? To find sellers.
Mm-hmm.
What do you mean? Well, this is a strange thing to say. No, the reason it's going up is because there's no sellers, so it's looking for sellers.
Mm-hmm.
It's going on a journey. Oh, there's a chart going up here. You know, it's a boom, 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 boom. Nobody's selling. Nobody's selling. What's it looking for? Sellers. At some point, it's going to find some sellers, but nobody's interested in selling anywhere in there, so it goes up. You
Mm-hmm.
know, and it goes down, looking for buyers. Right now, when this market, I'm going to make this volume a little higher here. Um, when when this market starts to see this market goes down and makes these legs down right here,
Mm-hmm.
and this level right here is Friday's close. Today's Monday. Is
Mm-hmm.
Friday's close. So it comes down, it tags Friday's close, it goes through it by about 10 ticks, 9 ticks. Okay. Now, what happens is there's all these guys that waited for the market to go A, B, C, D, E, F, G, H, I, J, K, L, M. M's the 13th letter of the alphabet.
Mm-hmm.
That's a lot of waves down. Now I know I kind of skipped this out, but just accept that. All right. Okay, so these guys decided, oh yeah, the crude oil's got 7 minutes left in the day, and it's going to zero. So they decided they're going to sell right there.
Mm-hmm.
Talk about waiting. Let's wait until it's driving right into Friday's close and so these guys sell here. Now what's going to happen is initially these guys have stop loss orders all through this range here.
Mm-hmm.
Now look what happens right here. You get this volume come down like this, and then you get this high volume bar. Well, why do you get a high volume bar there? Because all these sellers stepped in to push it again right there. All right, so you got a bunch of shorts in here. You got a bunch of shorts adding in again in here.
Mm-hmm.
Because it's going to zero today. Everybody knows that. It's got 2 minutes left in the session.
Mm-hmm.
It's going to zero. And so what happens is this starts stopping all these guys out.
Mm-hmm.
Now, so a rally begins with short covering. guys who got short who are getting out. Now, what's short covering is old money.
Mhm.
It's people leaving the market, not people entering the market.
Mhm.
Big difference.
Mhm.
Big difference. So rallies always start with short covering because it was going down and these guys are going to get out. And then in order for the rally to continue, new traders need to step in. New money needs to come in to propel it higher because
Mhm.
at some point the stops are going to run out.
Mhm.
Now, most of the time throughout the day, this alternation of this short covering long liquidation cycle is what's driving the market. That's why traders get on the wrong side. And so what'll happen is here is the buyers, the new money will come in here as these guys get stopped out and propel this higher.
Mhm.
So there's the two phases. It's short covering and then new money, old money leaving and new money coming in.
Mhm.
You could also call it dumb money and smart money.
Mhm.
Yeah. Now to the short side, it's opposite. You get long liquidation, which is old money getting out, and then new money coming in. Now,
Mhm.
we've talked about before in these interviews, notice how this volume is decreasing here.
Yep.
Yeah, markets rally on low volume, on declining volume. Why?
Mhm.
Because there's nobody left in there and there's no opposition.
Mhm.
And if there's no opposition to the movement, then it's going to go on low volume. So markets rally on low volume, or markets trend on low volume is the best way to put it.
Mhm.
So, anyways, I'm not sure if that entirely answered your question. There might have been another step to that. But when you get that concept under your belt, that what's initially driving the market is people getting out, not people getting in, then that can kind of help you to have a little bit more profound understanding of what's driving the market.
Mhm.
Is it new money or old money? Because if you don't have new money stepping in, it's like, for example, uh, when this market gets up to this level right here, this was a decision point right here, this high
Mhm.
where the market went from long to short. It changed its bias right there.
Mhm.
So notice what happens as the market gets up into that region again. You start getting all of this kind of stuff.
Mhm.
You know, it's an indecision. It's like, oh well, are we going to go higher here? Well, we need new money to step in and drive it higher. Well, and then it flops around. This is another dangerous trap that traders get themselves into. They wait for a move to happen, which is not how you want to trade. They wait for a move to happen and then they get in late.
Mhm.
Well, usually what happens more often than not when you get an abrupt move in the market, it'll chop around. And it's going to chop around just about the size of your stop.
Yep.
And so that's why you want to get in early. I used to call it first opportunity. You want to get in at the first opportunity to get in so that the market can run away from you. And when you look at it from a statistical standpoint, what are you doing? You're trading from a normal market situation to abnormal. You want the market to go from normal to abnormal over the span of your trade.
Mhm.
Because normal is just chopping around and finding its value. And then abnormal is when it goes on an excursion like this thing that you're seeing right here. And
Mhm.
so that's what all these lines are on this chart. This one right here, this orange one, is a median line. So what's a median? It's a measure of central tendency.
Mhm.
Or put in simple terms, it's a measure of normal.
Mhm.
So I want to trade away from normal. You'll notice that when the market's moving away from this line, a lot of times you get these tails on the bars.
Mhm.
See, that was a decision point right there because it came back up to normal, and these guys were saying, no, we're going to push it lower, but then it didn't work.
Mhm.
So by the time you get to the other side of that thing with that tail on there, you know that a battle was conducted in the span of this bar, and it's going higher here, moving away from normal. What else is normal? This one right here. This is a form of an average line. I call this an alignment trade
Mm-hmm.
as you're moving away from these things. So what do? You tag Friday's close, you come up through the median and um, through that, and then the background's green, and you get this really high volume thing here, and you get this oscillator breaking out higher on a double level right there, and so that battle is being lost right there, and you could trade that higher. Just using that as an example. And then you trade from normal, the orange line or the blue line there, to abnormal, away from it.
Mm-hmm.
And then then the orange line and the blue line are trying to play catch up.
Mm-hmm.
That's what you want to get into when you're trading. You don't want to wait for it to get away from it, and then you don't want to get in up here. And so you try and align yourself. I call it the alignment trade.
Mm-hmm.
Trying to align yourself with a movement away from something that represents normal.
Yeah. Mm-hmm. I see. And then you got the halfback as well.
Yeah, the halfback is another measure of normal. So these three lines that are on the chart here, the orange one, the red blue one, red cyan one, and the yellow one, all those are measures of some measure of central tendency or normal.
Mm-hmm.
Yeah.
Great.
Yeah.
Good. Now we did slightly touch the subject of trapping, but I want to explore it in detail in the next interview, if that's okay with you.
Yeah, sure.
All right. And let's see, it's been about an hour, so let's wrap it up. And we are also doing another Periscope session tomorrow, so that should be fun. And um, depending on when this video is posted, we hope to see you there.
Yeah, guys, join us on Periscope TV. You can watch that through your phone, and also with our other social network channels, Instagram, Snapchat, and Facebook, yeah, Twitter. Um, you can find those by going to the oiltradingroom.com, just oiltradingroom.com, and go to the social page and sign up for those. I have a lot of things going out on those channels just about personal development and things like that, and we talk about all kinds of things having to do with success and self-empowerment and whatnot in these other sessions that we do. In these particular sessions, we talk about trading specifically, but then in the other social networks, we're talking about developing into a master trader and the kinds of concepts that might sit behind that. Yeah,
Mm-hmm.
and so it's a really good opportunity for you to get a kind of a bigger picture view and be part of that kind of expansion of consciousness that's happening.
Mm-hmm.
Yeah.
Yeah, and I just want to mention that on Periscope, uh, what I love most about it is that you can come in and literally ask a question, Rob, live yourself.
Right, and I so strongly encourage you to do that.
Yeah, so
So you,
Rob,
yeah,
search
everybody
for
becomes a
Rob Mitchell Success on Periscope.
yeah, and so it's just Periscope .tv, and then there'll be a little button up there, Android or iOS. Just click the one and get it installed, and then join Periscope.tv Rob Mitchell Success, and then you'll be notified when we go live,
Yep,
which is really cool. Yeah. So,
awesome. Thank
all
you
right,
very
again,
much, Rob,
Vadim.
for another interview.
Yeah,
And
thanks for having.
yep, we'll talk to you next week.
Okay, man. Thank
Uh-huh.
you. Bye bye.
Bye bye.